Hello everyone and welcome back to my channel. In this video, we are going to cover ISA 402 Audit Considerations Relating to an Entity Using a Service Organization. The name might sound technical, but the concept behind it is actually very practical and very relevant to the way businesses operate today. Let me start with something simple. In today's business environment, do companies perform every single function internally? The answer is no. Many companies outsource certain processes. For example, payroll may be handled by an external payroll service provider. Accounting software may be hosted on a cloud platform. IT systems may be maintained by an external technology company. Even customer billing or claims processing may be outsourced. Now, here is the important question for us as auditors. If part of the financial reporting process is handled by an external organization, can we simply ignore it because it is outside the client's premises? Of course not. And that is precisely why ISA 402 exists. The objective of ISA 402 is to guide the auditor when an entity uses a service organization and the services provided are relevant to the preparation of financial statements. Very importantly, ISA 402 does not require us to audit the service organization itself. Our responsibility remains focused on the financial statements of the user entity, the company we are auditing. However, if part of the accounting system, transaction processing, or internal control system is handled by an external party, then we must understand how that affects our risk assessment and our audit procedures. So, the core idea is very clear. Outsourcing a function does not outsource audit responsibility. As auditors, we are still responsible for obtaining sufficient appropriate audit evidence. Before we go deeper, let me clarify three key terms. First, the user entity. This is the company whose financial statements we are auditing. Second, the service organization. This is a third party organization that provides services to the user entity, and those services are part of the entity's information system relevant to financial reporting. Third, the user auditor. That is us, the auditor of the user entity. There may also be something called a service auditor, which is an auditor engaged to report on the controls of the service organization. We will discuss this shortly. These definitions are important because ISA 402 revolves around the relationship between these parties. In the past, businesses were more centralized, most processes were handled internally, but today the situation is very different. Cloud computing, shared service centers, outsourced payroll, third-party logistics systems, all of these are common. When key processes affecting financial reporting are outsourced, risk may arise outside the physical boundaries of the entity. If we ignore those risks, we may fail to detect material misstatements. ISA 402 ensures that we extend our understanding beyond the walls of the client's office when necessary. ISA 402 applies when the user entity uses a service organization and the services provided are relevant to financial reporting. If the outsourced service has no impact on financial reporting or internal controls over financial reporting, then ISA 402 may not be significant. The key question we must ask is, does this outsourced activity affect financial statement amounts or disclosures? If the answer is yes, ISA 402 becomes relevant. The first step under ISA 402 is to obtain an understanding of the nature of the services provided, how those services affect the entity's internal control system, the significance of those services to financial reporting, the risk of material misstatement arising from those services. This links directly with ISA 315 on risk assessment. We cannot assess risk properly unless we understand how outsourced processes operate. For example, if payroll is outsourced, we must understand how employee data is transferred, who authorizes salary changes, how errors are detected, how reports are generated and reviewed. Without that understanding, our risk assessment would be incomplete. Now, let me discuss something very important: service auditors report. Some service organizations engage their own auditors to evaluate and report on their internal controls. These reports are often referred to as Type 1 or Type 2 reports. A Type 1 report provides a description of the system and evaluation of the design of controls at a specific point in time. It does not test whether the controls operated effectively over a period. A Type 2 report provides a description of the system and evaluation of design of controls, testing of operating effectiveness over a defined period of time. From an audit perspective, a Type 2 report is generally more useful because it provides evidence about operating effectiveness. However, and this is critical, we cannot automatically rely on these reports. We must evaluate whether the report covers the period of our audit, whether the controls tested are relevant to our client, whether the report was prepared by a competent and independent auditor. Professional judgment is essential here. Another important concept is complementary user entity controls. Service auditor reports often assume that certain controls are performed by the user entity. For example, the service organization may assume that the company authorizes payroll data before submission, reviews payroll reports, restricts access to employee master files. If these controls are not performed at the user entity level, then reliance on the service organization's control may not be appropriate. So we must verify that complementary controls actually exist and operate effectively. This is often overlooked, but it is very important. In some cases, a service organization may outsource part of its services to another organization. This is known as a subservice organization. Now, the situation becomes more complex. The service auditor's report may include the subservice organization. This is called the inclusive method, or it may exclude it. This is known as the carve out method. If it is carved out, we may need additional procedures to address the related risk. We cannot assume that everything is covered unless it clearly is. Sometimes we may not have access to service auditor's report, or the report may be outdated, or the controls may appear insufficient. In such cases, we must respond appropriately. That response may include performing more substantive testing at the user entity level, communicating with management, reassessing risk, considering the implications for the audit opinion. Remember, lack of access to information does not remove our responsibility. We must still obtain sufficient appropriate audit evidence. If we cannot obtain that evidence, we may need to consider a modification of the audit opinion depending on materiality and pervasiveness. Finally, ISA 402 requires proper documentation. We must document our understanding of the services provider, the risk identified, the procedures performed, our evaluation of service auditor reports, the conclusions reached. Good documentation demonstrates professional judgment and supports our audit opinion. Let me summarize ISA 402 in a simple framework. First, identify whether the entity uses a service organization. Second, determine whether the services are relevant to financial reporting. Third, obtain an understanding of the services and related controls. Fourth, assess the risk of material misstatement. Fifth, obtain appropriate audit evidence, which may include evaluating service auditor reports. Sixth, respond appropriately if evidence is insufficient. The overall message of ISA 402 is straightforward but powerful. Modern audits must reflect modern business realities. Outsourcing does not reduce the auditor's responsibility, it simply changes where risk may arise. As auditors, our duty is to understand those risks and respond to them appropriately. And that is the essence of ISA 402.
That's all for today, and Allah Hafiz.